So you're wondering, what is a bridge loan and how does it work? Well, in this video we're going to do a deep dive into the world of bridge loans and discuss why you may want to consider one for your next home purchase. Stick around to the end and you'll see why a bridge loan may be more advantageous than a recast. So we're going to get after it right now. If this is your first time to this channel and you want to know everything about financing a home purchase, then subscribe below, tap the bell for notifications so you can be the first to know about updates to the mortgage financing world. First off, what is a bridge loan? Think of it as a financial bridge. It's a short-term loan that bridges the gap between buying a new home and selling your current one. Another way to think of it is as an advance on your equity before you've sold your current home. It provides you the funds to purchase your dream home, and it allows you to make a non-contingent offer so you can compete and your offer can stand out. It can also help you appear to be financially stronger in the eyes of the seller. Let me give you an example. One time I had some clients who were looking to downsize and they wanted to be in a position where they can make a non-contingent offer, so we went the route of a bridge loan. The price range for the new home that they were looking for was around $500,000, and they were able to obtain a bridge loan of $250,000. So on paper, they were able to make an offer and state that they were putting down 50%, which looks huge in the eyes of the seller. Now, if they were competing against another couple who, let's say, were trying to use their own funds from their checkings or savings, whatever they could scrape to come up with for that minimum down payment and closing costs in order to make their non-contingent offer, they don't look as strong with 5% down as my clients did with 50% down. So by having more money to put down, this also allows you to deploy other strategies such as escalating the price, offering appraisal gap guarantees, or both. Now, there are some requirements with a traditional bridge loan. First, you must be able to qualify, meaning your income needs to be enough to support your current mortgage payment, the new mortgage payment, and the bridge loan payment. There are some new bridge loan options that may not count your current mortgage payment, or they may not count the bridge loan payment. But typically you need to be able to support all three with your income, and that may or may not be realistic for you. Secondly, the bridge loan is not going to advance you all the equity in your home. Typically they're going to go to about 80 or 85% of your home's value. This is because you don't know yet what your home may sell for. So we may need to make sure you have a buffer to make sure that you're given less than what your house sells for. The banks also want to make sure there's a buffer there to absorb your closing costs. You're going to have realtor commissions, transfer taxes, all those things associated with selling your house. So you need to have enough equity left over after the bridge loan is taken out to take care of those things. Thirdly, a bridge loan is a short-term loan. It usually ranges from 6 months to a year. The monthly payments are interest only, which means you're only paying the interest that accrued in the last billing cycle. There are no principal payments. As the banks know, the goal here is not to pay this loan off over time, and you're not going to make much headway in 6 months. So this does make it more manageable to afford the payment while you have your current mortgage payment and the new mortgage payment. But let me give you an example to show you how this works. Let's say your current home is worth $500,000 and you have a current mortgage on it for $300,000. The bank will give you up to 85% of what your home is worth, so 85% of $500,000 is $425,000. And let's say you already have a mortgage loan for $300,000, so we subtract that $300,000 from the $425,000, which leaves you $125,000 in equity to use as a bridge loan. So you buy your new house, you use the $125,000 as a down payment, you get settled in. Meanwhile, you sell your old house, the mortgage of $300,000 is paid off, the bridge loan of $125,000 will be paid off, and then whatever is left over from the sale goes to you. And you live happily ever after in your new home with your new mortgage without having to do anything else. Now, one quick note to add about bridge loans. There are some closing costs associated with the bridge loan, more than you would have with a recast, but the benefits may outweigh the costs for you to be able to make a non-contingent offer with a larger down payment, offer an appraisal gap guarantee, or be in a position to offer more than the list price. So you need to decide if it's right for you and your family and the housing market that you're in. If you found this explanation helpful, don't forget to share with your friends and family, and stay tuned for more mortgage insights.